Traders, Gary Wagner here just before 9 o'clock in Honolulu, 2 o'clock in New York on Thursday, the 6th day of March, 2014, and this is the daily report for gold and silver. Nice showing across the board with moderately higher pricing today in gold, silver, platinum, and palladium. In terms of percentage gainers, it's back to our little friend silver, up 1.68%, 35 cents on the day, 21.50, 21.51 current print on the screen. That being off of this 240-minute chart, low 21.00, high 21.71, and as I said, currently putting it up about 35 cents on the day. To gold on the right, trading up about $14 on the day at $13.50. It has had a low of $13.30.40 and a high of $13.53. Before we start our technical analysis in the show today, I just wanted to kind of briefly talk about stops. We currently have our stops sitting in gold first. It is at 1327. If we take a look, that's this mark right in here. This is a very, very short term, of course, 240-minute chart. My idea behind it, of course, was to keep us below these series of lows. When we look at our daily chart, as I said, our low today was 1330, where we have a 27 stop. Doesn't really make sense to move that yet until we get a series of higher highs and higher lows, and I should say if not when, and then we'll effectively trail the stop up as we did on the last trade. Right now where it sits, if it was to turn around and come back down, it would basically knock us out at a push, but we don't trade for a push. As far as silver goes, low in silver today, 21 even. That's right in here. Our stop is sitting at 20.90. It's below that 21 mark. And the fact that we've had lows, basically 10 cents from our stop also tells me that we've got a very, very tight stop, and we want to see that market begin to gain a little bit of steam and a little bit of emphasis. So my recommendation is to maintain our current long positions, maintain our stops. Of course, it's all about tomorrow's jobs report, and traders as well as investors are kind of sitting wondering what we're going to see when that report does come out. You can see by the higher pricing of precious metals where the bets are lying. But technically speaking, we still are showing a good amount of resistance. This up around 1360. I draw your attention to these last sets of highs. Now, of course, these last sets of highs, this happened back in November of 2013 up here. This is when the market is sitting at 1360. We had another high preceding that at 1435. Market, of course, comes down, and when it does, we get this second occurrence of these lows at 1181, this being the second of our double bottom. And from there, of course, the market is genuinely taken off, but there's a couple of areas that we believe we should find some resistance. The first area that we were looking at was roughly 1329. That was our initial target. That's right here. The market did come up. It actually did find a little bit of resistance, retraced just ever so slightly, 23% if we look at it from the start right here at about 1250 up to here, 23% retracement. It moves up to the first of these highs, this being 1340. Now 1340 down to this 1320, of course, this being closer to a 38 or a 50% retracement. And when I say that, I'm simply referring to this small move right in here, not the entire move. And of course, then we saw what we're witnessing where we came up, we made that top, and we absolutely, with this low in play today of 1330, we've actually gotten some good support. So what was formerly resistance, 1329, I currently am pegging as support in the market. Now I've gone ahead and I've pulled up our daily chart. We've been doing some fib work on this particular chart, but what I find interesting and is fairly noteworthy, something that I believe really warrants your attention here, is a variation off of a pattern that we're seeing, but we're seeing it in a very unusual spot. And the pattern that I'm talking about is the three-river morning star. By definition of a three-river morning star, the first law is that it occurs after a downtrend. Well, we certainly don't get that, and that's why I'm looking at this as a variation. But you get this downtrend, and then you get a final red candle as this market moves down. I know that I'm drawing it in blue, but you get a final red candle as the market's been coming down, you'll have a series of red candles, of course, and then you get a star which gaps at on a cash market or below on a standard market, and then you get that green candle which kind of takes out of the range and moves back up, and it's these three candles that give you that variation. Now, the pattern that I'm looking at, and you'll see what I mean, is right in here. It's on a daily chart. It's these three candles. Market comes up, you get this down day, you get the star gapped in the center, and then a green candle. So you in essence have the pattern being correct, but the pattern is found in the opposite area of where you would typically look for it, because we look for these patterns, of course, after the market has had an extended sell-off. Here's a variation, and when I say variation, I'm talking about candle color. The red's down, the star, and then the green candle. And so for that reason, it's quite an interesting pattern, because, as I said, we typically don't see that at or after defined rallies. Now, when we look at this top in terms of this particular chart, you can see this very nice bowl that's formed and this bottom that we've really etched out at 1181. And so the question that remains is, will we have enough momentum in this current rally to break through this particular area? Because if it does, we have our initial targets that are just above this, and then we have other levels of resistance that we'll talk about as this trade actually unfolds. Now, we are looking at our daily chart, and of course on this daily chart we have our Andrews pitchfork. Let's go ahead and kind of compress it so you can see what we're looking at. Here's our pitchfork right in here, handle, and then the two outer prongs. And what we're looking at when we look at this is the fact that we have broken through the 23% level, and realize these are what I call cascading channel lines, because they cascade up or down depending on how we're setting up the Andrews pitchfork. But as this market traded, we can effectively see points where you have this 23% be supportive. You can see when it breaks through this, the dramatic shift of where it's moving down to, and it doesn't find support till the 76% level, comes back up, finds resistance right here at the 38%, but when it comes back down, it really has to go to the end of the handle. And what's significant here is the fact that it broke through this 23% level, because if it's going to continue on this path, it really has nowhere to go until it hits this handle, which is at 0. Of course, as I said, this is cascading. So when we look at a cascading channel line, as we move it closer, we actually get a real idea of what we're looking at for the top of it. And right now, the top of this channel line, once we scale it to our current time period, takes us right around 1400. So that's the next real level above the 1365 in terms of our resistance areas. So traders, yesterday I brought up an alternative count that I've really been looking at, and we really couldn't even consider or look at this as a potential count until we had an effective bottom in the market. When I say effective, I mean that we stopped the bleeding, so to speak, because realize up until we hit this bottom here, the market had been on a genuine tear to the downside all through 2013, right here, in which we saw it lose almost 30% of its value. And when we came out of this dramatic move to the upside, it certainly took many traders by surprise as we went into this sideways market here. And there's a couple of different counts, but what I'm looking at is the potential for this bear count to actually have ceased or worked itself out. And one of the counts that I'm looking at is very, very simply an A, a B, and this is our 5-leg down C. Of course, the 5-leg down C was a truncated bear market truncation. If that's how that count can effectively be looked at, in other words, if the model carries weight, there's a key distinction in terms of our model, and that key distinction is our current set of waves, because right now, if we look at ourselves still being in a bear count, what we're going to expect is something like an A, a B, and a C. However, after that, you return to that bear count in which you have a series of 5 waves down. So you get 1, 2, 3, 4, 5 down, ABC up, 1, 2, 3, 4, 5, ABC up. Okay, if in fact what we saw here was a traditional, although extremely steep correction following this tremendous move, so we get 1, 2, 3, 4, 5, we get A, B, C, then we would look at a count effectively being 1, 2, 3, of course third cannot be our smallest, 4, and then 5. Now, time parameters. I would look at this particular, if in fact that's what we're looking at, this cycle here is going to be a 2-year cycle. So what I'm saying is that we have the distinct possibility that we have slowly witnessed the changing of the guard, so to speak, and what we have been seeing is that conversion from bull to bear market. And one thing that's interesting is if we look at that model, that really explains the activity we saw here at the end because it's shuffling between these prices, but it bottoms with a double bottom down there. And so it's definitely worth us noting. And so what I've done is I have pulled up a 3-day chart, and on the 3-day chart, really what we're looking at is a possibility that as this market went up, wave 1, wave 2, this would be wave 3 here, this would be 4, and then we would go into a final impulse wave, 5th impulse wave. And so with that in mind, as you can see, the key is not really affecting our strategy and our trading implementation now because we're bullish whether it's a counter trend or we've gotten a conversion back into a bull market. But where it becomes really important is that overall big picture over the next year to 2 years. And then finally to silver. As I said at the beginning of the show, our current stop sitting just below 2090. I think that stop has got to stay where it is. We were fortunate enough that it wasn't hit when we hit these lows of 21. I'm still showing really, really key support there. Really, really strong resistance at 22. After 22, the next real top has got to be 23. And so the correlative numbers that I'm looking at in terms of gold is if the market moves back to this area, we're looking at a move to about 1,400 in gold. And this area, I believe, would correspond with those levels at about 1435. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Friday for the weekly wrap-up and review.